Hello and welcome to the Core 4 Show. I'm Coach Brandon, and we're here to deliver another week of fantastic journey news. And the journey is all about getting from where we are to where we want to be financially. I mean, we look at all of this crypto world, we look at all of these financial instruments, and we say, how can we make money? And so the Core 4 journey is unique. The Core 4 journey allows us to understand that there are four major areas that we want to be associated with when trying to grow our capital. I'm not talking about your capital, I'm talking about our capital. And what do I mean by that? That means a couple of things. Number one, mindset. What is our mindset for being able to grow our wealth? How do we do it? When do we do it? Where do we do it? All of that stuff. And I've been super scammed, not just a little bit of scam. I've been super scammed out of stuff. And because things are packaged in this rosy petals and all the rest of the stuff, and so you buy into it. But we actually have more than that. We have like a Core 4 initiative that you would look at to kind of define and see if something is really real, right for you, and worth the risk. And then we want to do number two is get rid of our 9 to 5. I'm tired of the 9 to 5. As a matter of fact, I'm coaching a high school right now, and I do love it. But the idea that I have to be somewhere at some time at something is different. But I understand it. And that's a choice that I have made, and I love the choice that I've made. And so now we have the third thing, which is active and passive investments. And so passive means you do nothing to touch it, but that typically means you have to turn your money over to someone else. And so you're giving away self-custody. And so there are rules to that. There's a certain amount of disposable or discretionary money that you want to be able to whatever, you want to invest in. That's what you're going to use so that you don't over leverage or put yourself where you invested more money than you can afford to lose. And so this is our journey, because we're not promoting this as we're financial advisors. And then finally, number 4 is, what does your retirement look like? I know what my retirement looks like, and it's not where I want to be. I was talking to a good friend of mine, and he's a very, very, very successful businessman. And so when he told me about how much money he could live on right now if he retires, and I'm like, wow, $400,000. And he's like, yeah, but that's just not enough, because he's making millions now. And so I'm like, well, I get it. But he's like, I got to work, what did he say, 15 more years. And I'm like, okay, but maybe if he looked at some alternative financial opportunities, super conservative, then life would be a little bit different. So anyway, we have a panel of people. I tell everybody the creed is what? Does everybody know? Yes, that's right. You said it. That's become a subject matter expert. Number 2, even more importantly, become the best version of yourself. And number 3, even more importantly than that, because they are on levels, they're layers. And that's finally surround yourself with people who inspire you. And that's exactly what I do. And so because I do it, that's my family creed. And that's the creed that I'm letting you guys know as well. And so our panel includes Eric Majors, who you'll hear from this first, Chris Pulver, and James Bishop. James and Chris are absolutely phenomenal. They're going to give you economic outlooks for the week. You get to actually track week by week by week by week by week and see how well they have grown. It's been amazing to work with these tremendous panels and my team. And so these guys inspire me. And so you guys get a chance to share that inspiration through the Core 4 show. So without further ado, we'd like to bring Eric on. Eric is a part of Liquidity Pools. He's a master at liquidity pools. And so he has a course that shows you how to basically create liquidity pairs, put them together, start making a boatload of money off of the fees. It's very low risk, especially for the crypto space, because you're making money on the fees. So the volume needs to be there. And then when the asset goes up, you make more money. The asset goes down. If you're in range, there's a whole bunch of stuff that you learn in the course. So I'm going to bring Eric on. He's going to talk for a couple of minutes, just share with you the course. The course is $1,500, and there's actually automation in the course. And that's what makes it so incredible. Isn't that what's incredible? I love that. We can actually automate, Eric, this whole thing. And you got me doing some automation, and I love it, man. So welcome to the show. How's your hip feeling?
Oh, much better, much better. I had to go to a conference this week in Miami, and that Miami airport, flew American Airlines. I was at the terminal all the way at the end, had to go to the rental car center, hike with all my stuff on. But, it was great. I was actually, I turned that corner where I really don't have any pain, just hardly any pain left. And in about 2 weeks, I should get cleared by the doctor to just go do jumping jacks and run a marathon and triathlon and all that stuff. So
I love it.
really probably put on about 5 pounds, but maybe 10. But other than that,
Well, tell me a little bit about, so you're down in Miami. What kind of conference was this?
it was a PIPE conference. It's private investment and public equity. So it's about a bunch of guys. I used to do what I used to be what they call a deal guide. There was like maybe 125 of us, and probably back between the early 2000s through to 2008. And what we would just run around and find companies to list, and we would use our own money to list them on the stock exchange and get a piece of those deals. So I made millions in there. Spent a lot of that money, pretty much quite a bit of it, and I had to come back to the well. But anyway, I went down there and met a bunch of guys from that arena. I'm probably going to get back into that, listing companies again. But it was actually a really good conference.
I love it, man. So tell us a little bit about what's new really quickly for the course. Is there anything new, or have you put the things in that you wanted to put in?
I'll share with you a couple things here real quick. I'll just present something on the screen. Share screen, entire screen.
All right. So you haven't sent it over to me.
Oh. Am I allowed to share screen?
For some reason, it's not coming up. You're more than welcome to share the screen, but it's not coming up to allow you to present.
Huh. I see that. Oh, can you see that?
I can, and now you can see it too.
All right. Well, it's been a good, since the 5th. I can't remember what happened on that day, but look at what's happened since then. So, I mean, we're primarily dealing in crypto, and I have no complaints. So this is what I look for once a year. We get some big movements like this. It doesn't usually happen this quick. It usually happens over a period of, say, 3 months. And I don't know, it looks like I still think this has some steam on it right here.
Okay.
But I'm not concerned with that. I'm just throwing these up here to show you what has happened, which I'm sure a lot of people are aware of in the crypto space. So Bitcoin, Ethereum, Solana, which we trade a lot of over here, looks good for everything. Even the more speculative ones here, like Popcat, Smoking Chicken, went peaked up here from, when you're dealing with something that's at just under 5 cents, and it goes up to 10 cents. I mean, you're doing great. Now it's dropped back down again. But bottom line is, whatever these things are doing, we're making money. And when this kind of thing happens, though, we are making equity too, and that increases just the entire outlook. So one of my favorite pairs here that we trade a lot of is Ethereum and BTC on a specific spot, and this portfolio has jumped from about 132 to 163 and just in equity. But again, we're earning all the time. Same thing on the Orca side over here. I have some custom automation that we're running over here, but we did about 15% since the beginning of the month over here. So we're on target to do about 30% here and for the month. And then over here, probably going to be doing about 26%. So not bad. I mean, I don't know where else you can do 26%.
Not bad at all.
In a month while you're sleeping, so I don't like to work too hard. So just wanted to share all that with you there.
So let us know, like, when you think about the future of liquidity pools, especially since we'd be doing it independently, do you see this as a long-term venture? I mean, is this something that people can retire on, or they can think like that, they can replace their 9 to 5? Or do you look at this as like active investing and just kind of keep this on the outside, do it for a couple of hours a week, and while it lasts, but eventually it's going to rebalance itself some kind of way? Like, what are your thoughts?
I think that the technology around it might change 4 or 5 years from now. So I would get in there and get as much as we can now. But I will also acknowledge that things tend to really go to snail's pace pace when it comes to the advent of technology in blockchain. I don't know what it is, but I mean, we should be much further along than we are now. And so what I mean to say by that is that the way that we trade now to make this money, I think we got probably another at least 4 years run, maybe 8 years on this.
Wow.
So 8 years, 4 to 8 years at 20% a month isn't bad. And by then, I will have already made some other optimizations and be able to invite people into that. I'm getting ready to put some other stuff in the course that is other ways that you can make money on the technology of blockchain. So I'm not so keen on trying to predict the value of coins. And obviously, this is why I love to trade pools, because it doesn't matter whether the coin values are up or down. It's just you're making money every day off of it.
Exactly.
Nostradamus, you don't have to sit in front of your computer all day. In fact, I really try not to, because I've got a lot of very busy right now. But so I can't think of a better way for just even the single mom who maybe only has a few $1,000s to play with. I mean, that's still a few extra $100 a month if you just come on the calls every 2 weeks and make sure you're getting into the right pools, because new stuff comes and it's actually getting easier. It's getting easier to make the money. It's not getting harder.
I love it. All right. Well, I want to thank you. Let's keep the train moving. Thank you for the partnership. I know you're going to be back at work. I see you got like all these monitors behind you and stuff that's going on. So look at those. Keep those charts going that way. Keep whatever way it would look. Going up. All right. Thank you, my friend.
All right. God bless you.
All right. So listen, this is just one area to make money. And I love that area. And so there's more and there's more. And so I'll tell you, I am actually going to tell you about, what am I doing? My Go Baby trade. I started with a certain amount of money in, and it went down and it went down and went down. And so what it's doing is it's attached to my Coinbase. And so it was just kind of buying low and selling high, buying low, but the underlying assets that it was purchasing was dropping in value. And so my account was dropping in value. And so I was worried about it. But then, kind of like yield farming or liquidity pools, it eventually went back up. And so now it's back up and it's doing a lot of buying and selling, buying and selling, buying and selling. So it's a really, really interesting deal. So we also have a crypto core 4 bot that you guys could be interested in. And so this is Forex. So it's automated. It's very little to do. Just enjoy it and love it and run it. And so there's many more. You can contact us, but I just can't wait to get Chris and James on here. So I'm just going to jump on, man. Guys, how are y'all doing?
What's happening?
Hey, doing well.
Is that a orange on your head or a basketball with a?
No, it's the logo for a golf course called Cabot Citrus Farms. It's an extremely nice resort that they built. The first one was in Nova Scotia, Canada, I believe, and then they've expanded as well. So
it's not real unless Chris has played on the course.
I hear you.
James talked to me about it though.
Yeah,
I know that place.
Yeah, it's unbelievable. They just opened their second 18, and their rate for their first 18 that they opened went from $185 to $485 in a month. So,
wait, per 18 holes?
Yeah, for 18 holes. Yeah.
What?
Yeah.
And you golf there?
I've been there. Yeah, I've been there, but I didn't pay $485. Let me just be real. I don't do that.
Let's just make sure, Chris. He doesn't pay $485.
I don't do that. No,
I pay $485, but you just pay. They're just glad to have you. How much do they pay you?
Exactly.
Yeah, right. I'd be lucky to get a professional courtesy. They'd be like once in a lifetime.
Well, let's talk about a once-in-a-lifetime opportunity here with this guy. Donald Trump is now in office. We see crypto is going up. The markets are moving. Is this what you guys wanted to see?
I mean, yeah, we got the post-election move. Actually, similarly to I did a little deep dive on what the markets were planning on since 2016. Let's see if I can find that screenshot here. There it is. So I'll just walk you through this. This basically was the 2016 election trade. So this is Trump's elected 2016 until the end of the year. We have the S&P U.S. equities, small caps versus large caps, the bond yield 10-year, the real yield 10-year, break-even inflation, 2 versus 10-year, dollar versus Chinese yuan, gold, Chinese equities, and Bitcoin. And 2016 to now, basically the exact same. So the rhyme in the market was it did exactly what it did in 2016. So S&P is up, U.S. equities have ripped, small caps are up versus large caps, but that will probably taper off towards the end of the year. 10 years still going higher. The real 10-year yield still going higher. Break-even inflation going higher. 2 in the 10. A little bit different since we've already had the inversion to disinversion. The dollar's gotten stronger. Chinese yuan has gotten weaker versus the dollar. Gold is down. Equities down in China. Bitcoin has ripped way faster than what it did back in 2016. So, obviously give it, 8 years of a little bit more regulation. You got more money flow into it. The market cap's now, $1.75 trillion. So there's a real legitimacy to Bitcoin and crypto now, which is good. And it's not that it wasn't legitimate in the first place, but it just certainly got a lot more people excited about it. There's going to be some financial advisors that are basically going to force clients to have some exposure to it. I'm actually interested to see. It's just a matter of time, but I would hope by January or Q1 of 2025, we actually start to see some options in these SEC-approved ETFs. It needs to clear through the CFTC and needs to clear through the OCC, which is like one of the major options clearinghouses. So once that's official, some of the dollar cost averaging that I do in my options portfolio, IBIT will be a part of it. I'm probably going to maintain anywhere between 5 and 10%, but use options to leverage gains, have minimum exposure, still keep some ownership, but pick and choose when I want to own, and then just generate the income hopefully throughout the bull market that we may see. So there could be all sorts of great ways to play this moving forward. And as James knows, we've got some nice bumps going into the end of the year. So Bitcoin, let's say we have Bitcoin hitting 100K. Well, I've got IBIT measured out to hit around $61, just trading at 52. So percentage-wise, there could be some good upside there. I am curious, of course, what it looks like into 2025. I do expect slower growth. I don't think we can sustain the path that we're on. I don't think we can sustain, whether it's led by large cap, whether there's a rotation out of large cap into small cap. Bottom line is it's going to be hard to sustain the growth that we're currently in, and the growth that we're at, and the growth that the market's kind of become accustomed to. So I do think the reality is we have the benefit of seasonality right now, and there's not a lot to disrupt the market. If you see my screen here, looking at the SPX. I'm hedged right now, and I hedged right at the tippy top right after the election. So we had, election pop, and then we finished high for the week. I did buy some hedges in MES and MNQ. That's just hedging the index futures. And so I'm looking to see if this will just be a backfill. I'm not looking for any type of craziness, but if it is craziness, we're hedged to, hopefully make 400, 500, 600% on a couple of positions if we need it. But even if I turn it into a 2 to 3% hedge, I'll be happy with that. If we just simply come back in and backfill some of these election gaps. But all in all, it's just been active. I've said this the last probably month or so. I've just been actively trading income trades pretty much week to week and managing the portfolio and combing through them, making sure that our downside is protected. Our upside is just going to continue with the melt up. And that's the best thing I can do to go into the rest of the year. So I'm not doing anything crazy. I've got a lot of buying power. I'm sitting at about 40 to 45% cash. And we have plenty of firepower if and when needed. Buffett's got $325 billion, and I think there's a reason for it. And I listened to some interesting content this weekend on, what's Druckenmiller doing, what's Ackman doing, what about Buffett, what about a couple other hedge fund managers, what about Howard Marks at Oaktree. So it's interesting where people are positioned, what they're buying. But I think cash is a good spot. Especially right now, short-term treasuries, you can still get 4.5 to 5% on short term. So not a bad place just to park and have cash at the ready. But I just think you got to protect both ways to be safe, because the risk is certainly to the downside. If this market doesn't sustain this Trump trade, you can't fake it, man. I think the market's been fortunate to be as high as we are, have gold run the way that it is, have the markets run as high as they are with the concentration we've seen, have Bitcoin now running hot. And James, I know I'm talking a lot here, but I'll say that, look, if we start seeing, crypto and altcoins, and all of a sudden NFTs start coming back, and we start seeing just garbage tech getting popped up here, I'm going to be very cautious moving forward. It's like, think about what happened in 2021 and 2022 before we had a bear market. All the shit stocks essentially were doing well. NFTs were a big thing, and they could do no wrong. It's like, it's in that kind of euphoria phase. It kind of smells like euphoria. So I just want to be really mindful of that and make sure that I'm protected on both sides.
One of
Toby,
the things.
hold on a second. Hold on. Can you look up TMO?
Is that T-Mobile? Oh, Thermo Fisher. Yeah.
Yeah. What do you guys think about this?
Well, healthcare has been getting the crap kicked out of it because there's going to be some big changes at the top. I mean, if RFK Jr.'s coming in, I mean, healthcare has been in the red pretty much since Trump took office. And I mean, I would look at the fundamentals. I would consider this to maybe be something in the 500 to 450 space. But ideally, I mean, typically what I like to do is I'll let price come to me. So if I get something 450 or lower, then I'm more interested. If I take a look at it fundamentally here, TMO.
While you're looking that up, because
go ahead,
they
James.
do, so they have two kind of flows of business. Go ahead, you can.
Yeah, no, I just want to see, like, we got discounted cash flow showing there's still upside to it, which is nice. I just think it's been hit hard, but I could certainly consider some option trades on it. I just like this kind of mid fours before I mean that's 2023 lows. I mean, it's a long ways away from COVID lows, so I would just look to see if there's any type of ranging in here. But options only. I'm not looking to own stuff that's going to potentially fall. Look, moving forward, I'm not really trying to be a stock picker here.
Yeah.
I think the best thing is, buy the haystack, play the haystack. That means the indexes, and not trying to be a stock picker. I mean, look, man, Netflix pretty much broke the internet on Friday night, but I also think Netflix needs to come back and pull back. We talked about Eli Lilly. We've talked about, just any stock that like Carvana this year. I mean, there's stocks that have just ran hundreds and hundreds of %, and as enticing as they look right now, I don't know what they look like in 3 to 5 years. I don't know what they look like in 12 months. So I'm just not trying to chase stupid stuff that really, I don't believe in, or they're not liquid enough to, trade a bunch of options and, treat them fairly like I want to see. So anyway.
I will say for Thermo Fisher, going into that, they're, 30 out of 30 brokers are saying that the stock is overweight. Their weighted average cost of capital is tipping 8%, that's a lot for your debt in order to pay.
Yep.
And then on top of that, what they typically do is they work in vaccines. They do instruments, consumables, software. They have they also do test kits, reagents, culture media. There's too many irons in their fire.
Would they have to split?
Yeah, they would need to split. Yeah, they would need to split in order to go higher. I think that their target is probably in the 460 range, right around that same thing he was talking.
Yep.
But the other thing is that, if RFK is confirmed and there is some push on vaccines somehow, then this will be one of those stocks that suffers because they deliver test kits. They do the cultures and stuff like that. So Pfizer is a great example of what this could look like.
Pfizer's down to this. We haven't seen lows in Pfizer since like 2012 and 2013. I mean, I own Pfizer. And I can't believe how much this thing just can't catch a bid, but I mean, I get it. I just wonder if this is, is this oversold? Are we coming into deeper territory? It's like, I look left and we've got lows in 2014. We got lows in 2012. That's where we're at right now. I mean, we're coming back to great financial crisis lows on Pfizer. I mean, I'm sure it's a bargain at $12, but it's going to be a painful ride down because that's losing another 50% on the stock. So that's going to be an interesting.
I think Pfizer, they just have had in the past, in 2024, 1, 2, 3, 4, 5 different acquisitions.
Yeah.
And so whenever you spend that much money in a environment where interest rates are this high, and their cost of capital is 6.09%. So they're still kind of fairly low comparatively to the overall market, but still, with 6 acquisitions, that's 6 different businesses you're trying to add in and spin up in order to become profit producing. Right. 3 of those are international, where there are fixed costs associated with the goods that they provide. So, is it going to go to zero? No, absolutely not. Not with not with SSGA and BlackRock and Schwab and Wellington and Berkshire and all of them involved in it. But it's not going to go anywhere. To Chris's point and your point, and obviously the election is still fresh in mind. I think that there is a euphoria about from an election because something is going to change. I think there'll be some things that change for the good and some things that change for the worse. If we continue to, if the plan is, because again, it's like a high school election to a certain extent, like, free sodas for everybody in the lunchroom. Well, if he tariffs China 100+%, then that's a tariff is nothing more than another tax on us.
Yeah.
Right.
Like our cost of goods are going to go up. And if, the border czar that he's going to appoint, he was on 60 Minutes and said that if we deported every single illegal immigrant in the U.S. right now, we would have we would lose $1.7 trillion from our GDP. And then you take a hit like that. And speaking of, like, one of the things that it will be interesting to watch is right now the GDP to debt ratio in the U.S. is 120%. Its high of the last few years was in 2020 when it was 132%. The GDP ratio, Chris, if you look up total public debt as percent of gross, as a percent of GDP on the Fred website, you can see an unbelievable chart that to put it in perspective, 1980 it was 30%, 1990 it was 50%, 2000 it was 54, 2010 jumped to 64, and in 2020 it jumped to 132, more than doubled from 2010 to 2020. That is like an incredible jump in a decade.
I mean, just look, this is what's scary. Everything with our run from the recovery of the great financial crisis has been because of also just fueling and feeding public debt. Right now, I think we mentioned this actually last week. Our debt from the Reagan administration, or I'm sorry, our GDP from the Reagan administration, I think was like a 6 multiple, and it was a 36 multiple of debt. So the leverage that we have and the debt that we need in order to fuel any type of growth, it's a 2 to 5 to 6 times multiple just to get by with what we're doing right now. So, look, austerity doesn't exist in the U.S. government vocabulary, and under Trump, it's not going to be any different. So, I don't know. It's going to be, look, man, I don't know what people thought about 2016 to 2020. I don't know a lot of people that loved it. I don't know how this 2024 to 2028 is going to feel that much different, outside of, okay, it's different that it's not Biden and it's not Democrats, and people are so worried about the extreme left. It's like, well, we'll see where the pendulum swings, because if we have far right, if you've got, Republican House, Republican Senate, Republican president, and if that policy gets far right, we're going to see where that pendulum swings to see if people are like, oh my God, I can't believe this happened. So, at some point, I just think we're at one of the low points of politics, man. I mean, I think if people could just vote in no confidence, I feel like that would have been a better vote in 2024 than what we had.
Well, tell me a little bit about Elon Musk's underlying play with all of this. Like, there's something that he wants that's going to drive something through the roof for him.
Well, I think a couple of things. One, I do yes, this Department of Government Efficiency with Vivek and Elon, that is not. It operates outside of the government, so they'll be like consultants to Trump on what to cut, and who knows what they cut, right? Whatever they see inefficient, and it maybe it's, hey, we're gonna cut back on military defense spending of soldiers and start investing in Boston Dynamic robots. Well, okay, I can understand some of that, but you still need people to operate. And then you have other things you may cut, like something from the Department of Education and all of these other departments. So removing some of the bloat will help with that.
How transparent do you think that's going to be, James? Look, the guy owns Twitter, so he can make it as transparent as he wants to be, but also, I don't know.
Everything's going to be posted on the website.
Sure, I'd love it, and I'd love it. But then you see how lazy people actually are, because it's easy on social media just to post like, we need to cut the spending and do this and do away with this. But when it actually comes to, okay, look, you're given a choice between this and this, something's going to get cut. What do you do? I feel like most Americans would not know what to do,
Yep.
right? Or it's like, this affects me. I don't want those both to get cut. I mean, nobody knows. So I'm curious how transparent that process is. I'm curious also, you have to remember, DC is all a bureaucracy. So all this stuff is still going to have to go through Congress. It's going to have to go through the House. And I mean, the House and the Senate and the president, it's going to be interesting to see if they all unite to toe the party line and get things passed. And to what degree? Because the only thing that still remains bipartisan is probably the military.
Yeah.
And the only thing that remains bipartisan is lifting the debt ceiling. And I mean, we're going to have this discussion again in 2025. We're going to revisit this whole debt ceiling again. And we haven't heard about it for like over a year because it just got lifted. And I think we raised the debt ceiling, and all of a sudden we had $6 or $7 trillion added to the bottom line. Yeah. Like it's insane how fast it went. And so we revisited again. It's like we have the same situation. It's always the 11th hour, and then Congress likes to pat themselves on the back like they get something done. But at some point, I mean, there has to be a level of accountability, a level of some type of austerity where it's like, look, man, all we're doing is printing money, and it's just deflating, debasing, and things are getting more expensive. Mm-hmm. And tariffs on top of that, it's like, it's just going to fuel this potential. I mean, nobody knows what hyperinflation is, right? I didn't live through hyperinflation, nor did James, but it's like in this day and age of 2024, if we were going to hyperinflation in the U.S., I think we'd have a full-on financial reset. Nobody in this country is prepared for. You think crap is bad now? Put it 5 or 10 times higher, where nobody can afford anything, right? And even Bitcoin, the greatest asset in the world, can't outgrow hyperinflation.
So what years were hyperinflation? What was the last year?
It would have been in the 70s.
81.
It would have been 70s and 80s. Yeah.
Yeah. 81 was the last year because they put it this way: the interest rate in 1981, the central bank rate was 22%. The average mortgage was 26%.
What?
So, yeah. But you got to think though, the average cost of a house was like
$30,000 to $50,000.
Yeah, exactly. It was like $17,000 to $19,000.
Yeah.
So we may see a reset in that. And here's the other kind of thing to think about is that the age of the part of the reason why the debt to GDP ratio is so crazy is the age of our population. And we're losing a certain amount of taxes. We're also increasing spending on healthcare. And we're not replacing people fast enough in those certain industries. And so in like the military and other places. So you get to this point where what happens, it's all going to, and then on top of it, all the money we sent to Ukraine, that hasn't hit inflation yet. All the Green New Deal, that hasn't hit inflation yet. Like we have things that are going to create more inflation. And it's like, where do we put money? Gold doesn't outpace the inflation. I was reading something recently from Real Vision, or maybe, no, that was just something else. But recently I was reading some article, and basically we have the quote unquote 3% inflation per year plus an 8% debasement of our currency per year. So every day your money or every year you don't make 11% return on your money. Your spending power, your purchasing power is getting weaker. So when you think about that, awful, man. And what's funny is that, if you only look at the last 15 years, the S&P has gone up like right at 11% a year, but that was because of 2020 and 2022. All the way up till now, that amazing run that we've had, right? So that would tell you that average is 11%. So yeah, you can put your money in that, but what outpaces it? There's only two things that outpace it right now. Two. One is tech, and the other is crypto. Mm-hmm. So something like the NQ or the NASDAQ, but you have to be aware that prepared to see your money go down in order to see it go back up, depending on when you invest. Because you're never going to, a great man once said, if you're trying to pick tops and bottoms, all you're going to be left with is stinky fingers. Right. And that was, Chris himself said that. And I still, to this day, laugh at that statement. But it's true. It's the only two things, the NASDAQ 100 and crypto, are the only two things that outpace it as of right now.
I was looking to see what the average. So I know the risk-adjusted return for the S&P is average return about 8%, average pullback or drawdown about 13%. I was looking to see what the Nasdaq is because I know the Nasdaq has been the best performing index for the last 30 plus years.
Yep.
But I wouldn't be surprised if the Nasdaq average drawdown is probably in the high teens or even in the 20s. So I'll find that. I think Macro Trends probably has it in here. Usually they post a pretty good. Yeah, they'll do some drawdowns and stuff in here. Anyway, but I would imagine it's definitely going to be higher. Let me see if I can go returns on year.
So
compounded annual growth of the last 17 years is 16.87%.
Yep.
And the last couple of years was last 5 years is 21%.
Yeah, it's crazy. It really is crazy. But like I said, I mean, there is risk in all of that. So I mean, you got to be ready to ride that stuff with the Nasdaq because it's probably double. I mean, what'd you say the average was, James? 17%?
16.87%, yeah.
Okay, so I wouldn't be surprised. I mean, look, the markets are pretty darn efficient. So if we've got an 8% average and you got 16.7 divided by 8, that's almost 2 times the performance. That means that tells me I'm just guessing here, but I would imagine that the NASDAQ drawdown is probably in the 20s. In order to get that 16%, you probably have to have a 25 to 30% drawdown. And we saw it. I mean, 2022 was a 35 plus pullback. We had nearly 40% during COVID. 2018 was a vol crush where we had the big vol event January 2018. The NASDAQ dropped down like 25%.
2018 was one of the worst years. That was 4% return in the NASDAQ.
Yep.
2022 was a 28% drawdown. 2008 was a 38% drawdown.
I thought 2008 would have been like in the 50s, dude. We had like 56% peak.
You got to remember, right? The end of 08, it started the gains at the end of 08.
Oh,
so I'm looking at
okay. Well, I guess I'm talking peak to trough. Like we had a 50+% pullback from peak to trough, which would have been like running from 08 to 09's bottom.
Mm-hmm.
Yeah. Okay. So anyway, look, man, you got to risk it to get the biscuit. We know the deal. There's risk out there. I talked about this a lot in some live sessions last week. I know that it is annoying to me to have to put on hedges, but I feel like there is, I mean, seasonality aside, something still reeks of like, I don't know how easy the rest of this year is outside of we're not disturbing too much right now because it's still the same administration. Nothing is going to happen really until next year. And so maybe it's inauguration time, maybe it's Q1, maybe we'll see what Trump's cabinet's going to look like. But I could see a lot of this Trump trade fading until the market has the ability to get back up. And I wouldn't be surprised this, fellas. I mean, we could have the market with the Trump trade putting in the high, we backfill some of this election stuff, and then we chop for the rest of the year. And then we're going to wait and see what this market's really made of. Can we justify another rip of all-time highs? Or is it stagflation? Does the Fed break something? Does the bond market break? It's like, I think for the first time in 6 years, we go sideways for a second. And I don't know. I mean, it's been lower volume every single day. There's less buying at these tops. And outside of maybe the FOMO money that felt like, oh, Trump's in office, I'm going back into the markets now. Maybe they got their little short-term pop, but I don't see this really going too much higher without having another round of earnings seasons Q1 to justify it. Because right now, and James, we haven't talked about this either, but the Fed is back down to like a 50-50 December 18th. So there's no longer a market that's expecting to see a really dovish Fed. I mean, Powell this week had some comments at some type of tableside chat. I think it was a Wednesday afternoon, and like he actually rattled the markets a little bit because, I mean, we saw the CME watch tool change. I mean, I don't remember exactly what he said, but they took a victory lap in September talking about how good inflation is and how it's trending lower. But dude, they keep towing on this like 2% and that things are trending lower. It's complete bullshit. It really is. Like we're really living in a 3+% environment with, I think, fudge data. So we're here at 61%. This is as high as 85%. Now it's dropping. I wouldn't be surprised if we get into December 18th and this is going to be like a 50-50 shot and nobody knows whether it's going to be bullish or bearish. I would say this, for the market to keep buzzing higher, we probably have to see a pause by the Fed and not have the 10-year yield go higher. That's probably the best thing right now for the market to sustain higher runs, because if we have a 10-year that keeps going higher, it just makes the cost of borrowing more expensive, the fulcrum of financing more expensive, and that going into 2025 in a new year, having everything be another half percent to 1% higher, is going to be tough, right? I mean, mortgage rates have gone up 80 basis points since September 18th. Financing a car has gone up nearly 1% since September 18th. The bond market and the yields are doing the exact opposite of what was supposed to happen, which is Fed's going to cut, market's going to get all this rip because we're going dovish now by the Fed. I think the Fed, I mean, you can see that, I know one data point doesn't make a trend, but if I go to one quick data point here on inflation, we broke the streak. So we are almost back to our year-over-year inflation that doesn't look any better than July of 2023, which is right here. So here's July 2023, draw a straight line, and we had 1, 2, 3, 4, 5, 6, 7 that, yes, they did trend lower, okay? But now we broke that streak, and we're at 2.6 from a 2.4 print. I wouldn't be surprised in December if we print up another 1 to 2 tenths of 1%. And if we are right back near 3% again, this Fed is failing to tame inflation, and the country feels it, and people aren't stupid, and this is stuff that everyone's talking about. So I don't know. I talked about this a lot last week, and I'm hammering this out. The 10-year yield is probably the most important thing to watch to see if things are going to get better or things are going to get rough. Yeah. So that's my 2 cents on it.
To home. So one thing that is happening is that we're seeing a slowdown in the housing markets in the kind of big moves that have happened. So Florida, for instance, between in some areas 10 to 15 to 10% to 5.8% drop. I know Sarasota was down about 5.8%. Orlando's down about 10%. And then Texas, the overall state is down 7%, average home prices. Okay. So only in those specific states. So we're finally seeing a little bit of relief there, but it needs to happen, right? It's got to happen. We've seen inventories creep up now, but now that interest rates are so high, people can't afford to go buy those homes and at these crazy levels. So they're going to naturally creep up. And you figure that's going to be another year plus that they'll fall. Why? Because when you sign a lease, it's for at least a year. So, it is cheaper right now still, though, to rent versus buying a home. Like over 30 years.
That is completely market dependent too. Yeah. I mean, I would beg to differ with where I live, because it is actually better to, like, the reason I'm buying a house is because rent is no cheaper. Yeah. And it's actually going up because this place has such a strong seasonality where it's like a lot of money comes in, 4 to 5 months out of the year when it's dumping and everyone's like, Park City, let's go skiing. So everybody rents and everybody's got an Airbnb for the winter. I just saw a $65 million listing on Zillow Gone Wild for a Park City home. It's got its own underground basketball court, full NBA regulation basketball court underground. Brandon,
how much is it?
65 million, dude. No big deal.
I'm putting my offer on today.
Well, I said last week, because it didn't have a helicopter pad, I withdrew my bid.
Yeah, 100% market dependent. I can definitely say Florida for sure. It is less expensive to rent than it are. For sure. Yeah, less expensive to rent, but that's over a 30-year time basis. And then home prices. I also have a kind of a jaded view when I think about buying a home or whatever. It's more for lifestyle than return, because it's just going to be, if a third of the population is gone in 30 years, then where are all those homes going to be? They're going to be on the market. What's going to happen to home prices? Right. So it's not a storage of value anymore for people my age and younger.
It's gonna be the race to the rentals. Yeah. Like those will get scooped up and become. I mean, dude, we're selling this place here in Salt Lake City, and there are people that have money and they just make offers, and somebody's just like, here's $100,000 less than what you're asking for, but maybe you're desperate, and it's like, no thanks, we're good. But I'm sure that's happening, and I say that because there are some places that had their house listed at $800,000, $900,000, $1 million that they bought it back at. They bought it in 2018, 2019 for $300,000, and they're sitting on like $500,000 plus in equity. And so if somebody comes in with a cash offer and just offers $100,000 less and $150,000 less, like, some people will take it because they just justify, like, money today is going to be better and treated better than money in the future. So just like James said, I mean, our debasing is happening so violently that, I mean, if you have a lump sum up front, that certainly helps now. versus the future. So
yeah.
Anyway, look, I don't know if this is a doom and gloom type angle, but the reality is I don't know what the next, couple of months look like. I think we could have a rocky end of the year. I think we could have, like I said, path of least resistance just because there's not enough to disrupt the market right now. But I will see the next big event. So, I mean, I'm going to be out of town here for the next couple of weeks. James, I hope I get to see you next week on Sunday, this coming week. But I would say that the Fed might be the last catalyst to potentially keep the market going or possibly see the reality check for end of the year and into Q1. If the Fed pauses in December, I don't think the market's going to like it. I think there's going to be some pretty aggressive deleveraging, and we'll see where that kind of floor sits because maybe it's 5% lower, maybe it's 10% lower. I did say this a lot last week in some of my live sessions. I mean, look, this is a pretty well-supported index with a lot of support, and you see all my moving averages here. But if we come back, just like we did here, we found some support with a 5% pullback. We had a 6+% pullback and a 20% pullback in Bitcoin. We had a 10 to 20% pullback here in the S&P and the NASDAQ and the futures market. I could see the same type of thing happening. We're at these all-time highs. I could see the same type of volatility where this market is just going to whipsaw and possibly slingshot back and forth for a while. And the good thing is I can trade that. I mean, if it gets damaging, and then this is a rally up here. I'll just delete this for a second. Let's say that we had this nasty spill and we come back and test this August low. Well, there's likely going to be a bounce there, but the next question is this a bounce that is the dreaded dead cat bounce where all of a sudden we break those lows again? If that happens, now we're talking some double-digit discounts. We're talking about some severe trend changing, and then all of a sudden there's going to be some doom and gloom of like, how low does this go and where's the floor going to be? And you're right back to guessing where the bottom is. You got to have cash at the ready. You got a dollar cost average. You got to be in this for the long run. And when I say long run for me, I mean, I'm talking to clients that are like, look, you got to give me a good 3 to 5 year horizon here. I mean, we've had a great year so far, and China is now like the what was performing really well in September is now just stagnant. I mean, and I'm still looking to see, like, does China have a pop to the upside? If they front run the tariffs now, do they maybe get a pump for the end of the year, or they just go into the crapper because it's just the facing trade war of 2025. I don't know. But Bitcoin picked up, silver and gold have pulled back. So I'm still long on those. I mean, I'm looking at something very simple. I think a 50 and then maybe a 30 and a 20 will be some allocations for me going into 2025. Take the traditional 60-40, throw it out the window. I want no interest in bonds. I don't care. I'll never trade bonds the way that a typical 60-40 portfolio does. I'd rather put it 20% Bitcoin and 20% gold and silver. I mean, now to do that, I'm going to do it probably 95% of that's going to be options. So, I mean, I can manage that exposure and I can keep that cost really, really cheap. But point is, I'm working the numbers here to make sure that, we can be defensive when we need to be, because I think there's a lot of uncertainty ahead with a whole new administration and a whole new horizon of politics that, I mean, ask and you shall receive. But I don't think anybody knows what potentially we could be dealing with if things don't go the way that we've been just manipulated. I mean, outside of 2022, I mean, I would say I would be a permanent bear right now if we didn't have a pullback in 2022. But we did, and it was a healthy pullback, and now we're sitting here with another 2 to 3 years. But you can go back to 70 plus years and see that every 1 to 2 years, there's always a double-digit pullback. Every 2 to 4 years, there's a recession. The one thing we also need to watch, James, I'd like your thoughts on this. What about the 10-year and the 3-month? We are very close in that 10-year, 3-month from getting back to the zero line. And every time this has happened in history, this is an undefeated recession indicator, and it usually happens within about 12 months. Yep. So I know you and I've talked about the kind of the Trader's Almanac thing in 2026, but yep. I would put us on very borrowed time. If this goes 10-year, 3-month, gets disinverted, I would say within maybe 6 months we have a hard felt recession that the markets will start pricing in.
Yep, 100% agree. I think again, still think that 2025 will end up being a flat to slight loss year, and then I think 2026 is. Hold on, I think we're going to be, having a little bit of a down cycle that could be spurred on from spending, that could be spurred, because if you reduce, that's another thing, right? The big portion of our GDP is government spending. If they want to cut government spending, then that's going to suffer. So we would have negative growth. We get a couple of negative growth, there you are, there's your recession. Another interesting thing when I was looking at your chart of the S&P.
Yeah.
We are 261 days since we hit the last 200 period moving average.
Not only that, I've been watching that all this whole year.
Yep.
Not only that, but what I also measure is the distance away.
Yeah, that's exactly what my next thing is about.
Percentage away, about 10% away.
Exactly.
Very cautious. Very cautious for that reason, because you can go back and go 30 years back, and you can see that we rarely stretch above like 13 to 15% above the 200 EMA without having some type of reversion.
Yep.
So
it's honestly like a slinky, it comes back, goes, and then it'll, move a little bit forward. But I think that if they cut government spending, if we increase tariffs, we're going to cut consumption down, and who the hell knows? It's gonna affect things. But
hey, if we drain the swamp,
yeah, right? Exactly. And
that was the promise of 2016.
Is that with options and futures, we can make money in down markets. Like I don't care what direction the thing moves.
Yeah.
I just want it to move. And if it moves directionally, we can make some great money, great hedges, and find opportunity. That's
right here for that move. I could turn probably a 0.5% hedge into a 5% buffer for my portfolio right there. So there's certainly ways to do it. And I mean, this was a useful hedge. That was a useful hedge. Right now, I looked on Friday. I had like a $300 position that was up over $2,000 going into the close on Friday. So I'm leaving it alone because I want to see, does this get worse? Do we continue to backfill the selection move? And if so, then maybe I turn it into $3,000-$4,000, which is a couple percent. But if we get all the way back down to here, depending on how accelerated that is, I could turn, also another thing that's exciting, I could turn a little 10-cent debit into a $2 to $3 credit, and that's 20 to 30 times my money. So if I hedge $1,000 and I turned it into 20 to 30 grand, that can be done. Now that's a bit of an outlier, but when it happens, this is why it's important to have those periodic hedges that don't cost you a lot of money, but you need them. You need them when the market takes a nosedive. So, and my concern is, nobody's watching right now. Like, we're kind of in euphoric mode. It's holiday time. The volume's getting really light day to day. And I could just see some type of like noisy little surprise where, like, in a 1 day, 2 day move, this market drops like 3, 4, 5%, activates all these selling bots and all these black boxes. And I mean, worst case is we halt. But man, if we have a halt in the S&P, James, and it drops 7.7% and they halt it, that thing's loading up with sells the next day. So we could probably have 10% real fast, man.
Yep. 100%.
Yeah. So just stuff to watch for. That's all.
Yep.
All right. Well, we're going to keep watching, and we're going to keep growing, and we're going to keep educating. This is how we do it. So what's next? One stock that you guys like for the week, James?
For the week, there's actually, I'm going to go a different route. Not going to go a stock. I'm actually going to go a crypto.
Oh no!
Yes.
In my world now.
So there's I don't know if you know who the founder of Real Vision was, or is, but his name's Raul, and he sits on the board of this company. I've looked into it and what it's doing and how it works and what the plan is with it. It's SUI USD, and you have to type USD to get it. Yeah, it's a smaller crypto. It's only $3 and some change. It's one of those that, I'll probably buy a little bit of. If I buy $38, 38 coins or whatever, or $100 worth, I'm not gonna lose my shirt if I lose the $100. But if it does continue to rally, as it could, because this is like one of those that has real world application. And I'm kind of just interested, even if it, just to hold it for a while. It's not going to be one I'm in and out of or anything like that. It's just buy it and forget about it kind of deal.
Sure.
Yep.
Let me see here. It's not there yet, but so I've got some positions. This is more of an income play for me. If China has a decent second wind, I would call it, because we had that big initial pop. They're still announcing some additional stimulus measures, and we had this nice little rip here, 1, 2, 3 correction. JD for me, all I'm looking for is this thing to pop back up into the 40s. So going from like low 30s to 40s, there's some decent opportunity there. I have a $40 covered call that would make me about $9,000. So that's the level that I'm watching. I'll keep lowering the cost basis, aggressively if and when I can. The three that I'm trying to do this on for some income, it's JD, Pfizer, and OXY, which is that's the Oxy Petroleum that Buffett and Berkshire is in. JD has good premiums for being a stock that's only $35, has really good premium. I mean, I'm lowered the cost basis from, I bought the stock at $43.90. And I think my cost basis right now is down below $38. And I've done this within about 3 weeks. So
wow.
I've taken the cost down. Let's just say $6 on a $43.90 stock. I've shaved off almost 14% of my cost within 3 weeks. So that's the power of options, and I'll keep doing that because I'll flip it for some income. But I want to see if this kind of China move here, seeing HSI is green, that's kind of live for Asia trading right now. We go into Alibaba, maybe the same type of thing. Just trying to find some support. I mean, the daily time frame coming back in that 200 EMA. Baidu, this one is this is a slippery sucker, man. We're coming right back down to these potentially same levels, but I would still have some option exposure there, but. Again, I've said this all year, like people just say it's uninvestable. I don't want to play China, which I get it. So I'm trading China on my own. I'm trading China with the options game. And, I was up a good chunk in September. I took some profit in September. I cut down some of the moves, but I'm looking to see if there's still, world number one, US, world number two, China. If they both want the same thing with growth, they're going to still add debt. They're going to still add spending. The money supply is going up in both of them still. And that's where I think we're in this like tail end of this Goldilocks cycle. We're in the tail end of this late cycle extension. I called it extension more so than expansion because I think we're on dust, man. Like anything that was in orbit, we're like puttering out. It's like the Jetsons car now. And I think that gravity changes.
The other stock I would say is Intel. I'm very big on Intel. They're down. They're $24.35. I've owned them since like $19. I'm riding it until it hits 45.50, and I may take half of my position off then. And this is a long-term play for me because they admitted back in 2020, they said, look, we're 3 years behind AMD. And our 2021, they said they were 3 to 4 years behind AMD and NVIDIA. They're about to surpass us. And they did. And they said, but what we are developing will catch us up by leaps and bounds very quickly. So there is gaps in the stock all the way back up to 60 and higher. So I'm A-okay with, just holding it. It's a low risk play. And that's me I own the stock outright, not trading options on it yet, but I definitely will. And I agree with what Chris said. If they both want growth, they'll both continue to invest in debt. I think there'll be some, remediation spending that'll help some growth as well. And, I think, who knows, right? You wish for the best, and if the worst happens, you already have a plan for that as well. So,
I'm in Intel already, James. I did a little, just income. I'm not long term. I had some long term, and I dumped out of the long term. We had all these this support here back here in the 25s. I took that run up through the little AI Mag 7 jump. So that was pretty solid. I mean, that was 100%. I didn't get all of it, but I got a lot of it. Now I'm back in with a cost basis at 22, get it called away at 24, make $1.80 a share. I got 1,000 shares. Nice. So make a few grand. It should be fine.
Yep.
All right.
Cool.
Well, look, guys, I mean, we're going to wrap it up right like this here. This is what Core 4 is all about. This is what our team is all about. Wrapping it up, showing us how we can take a look at the big view and then come down to the smaller and make some wonderful money for ourselves. You guys look out for Chris. Join Streamwise Capital. Look out for James, and his life insurance is just out of control. So thank you both. I will see you guys next week. Thank you.
Okay. Thanks, guys.
Bye.